The impacts of changing climate are everywhere, and these have an impact on how money flows through the economy. It impacts how we insure, how we lend, how we invest. Banks play an important part, and also lenders, in this value chain of how money flows through the economy and through our country. Dan and I want to talk about three things. I will take a brief look at how lenders manage risk, the current state of play. I'll pass over to Dan to talk about some ways to deal with challenges that these institutions face and share some case studies. And we'll conclude with the role of actuaries. For banks and financial institutions, climate risks impact the economy, which inevitably leads to risks to their business. That's quite obvious. How these institutions deal with these risks is harder. That's where rubber hits the road. I won't reiterate a lot of things some of you would have heard, the distinction between different types of risks and how it impacts. But I do want to talk about some of the challenges. But firstly, to acknowledge that banks do appreciate the importance of their role, of the role that they play in decarbonisation. In a recent Deloitte survey, banks recognised their responsibility and the role that they play in their economies, and they are already taking a lot of steps, as shown on the chart on the right. For example, things like financing companies doing things around climate or reducing their exposure to certain sectors. And also just important part of context is the regulatory environment. There's a lot of activity going on, and increasingly more and more recently, particularly around disclosures, climate disclosures and sustainability disclosures. So, and closer to home in Australia, organisations are directed to consider climate change as part of their financial reporting and risk management. There's responsibility of boards of directors in management of climate risk, and there's an important role in actuaries, particularly in insurance, where we play appointed actuary roles in advising and considering impact of climate in their work. So what's the problem? What's the problem that we want to talk about today? So what's happening in our country and also other parts of the world? Historically, financial institutions took risk away from individuals, from businesses, from communities. And what's happening now, as these risks get larger and larger, those risks are shifting from financial institutions back to communities, back to consumers, back to individuals, back to businesses. An example is where traditionally a lender would have relied on an insurance company protecting the asset that they lend against. The insurers don't want to insure a high-risk asset. And those people who have such assets, homes in flood-affected areas, for example, they become unbankable. And that's a problem for our community. The second issue, probably more of a journey of maturity that banks are going through. There's a lot of work that's already happened. We do see a lot of sophistication in banks in adapting to dealing with transition risks, how they deal with different industries, for example, but physical risk, how they understand and deal with physical impacts of climate to their customers. There's room for improvement there. So with that context, I want to pass to my colleague Dan to talk about different ways that he's seen in financial institutions to deal with these, particularly also from overseas. Dan.
Thanks, Mudit. Just want to check that you can hear me loud and clear.
Yes, perfectly.
No problem, thank you. In the spirit of time, let me just touch on the fact that we won't be able to cover everything today, but I just really want to maybe highlight the complexities around this and why this particular area lends itself to actuaries in question. So to build on what Mudit said, I think it's worth having a high-level overview of how climate change is affecting particularly the credit risk cycle. For Australian banks in particular, there's one particular or emerging area where there's a push to align strategies and products, in particular towards sustainability goals. In doing so, lenders contribute not only to the low carbon economy, but they also manage their own transition risks. So in other words, if you've got a product or a product lineup rather that supports green outcomes and decarbonisation, you're less susceptible to potential policy shifts in future. I'll discuss underwriting and approval processes later, but lenders are now having to gather more information to evaluate their borrowers' climate resilience and the overall impact of climate change on their credit decisions. Similarly, collateral management, hedging, monitoring, and portfolio management are all requiring closer attention and a lot more sophistication and technical knowledge. Default management issues are increasingly arising amongst general questions of responsible lending. So rescuing people who have homes in high-risk areas may only leave them vulnerable to potential future events that may occur. Alternately, the other option is not that much more appealing. A lender may protect their own portfolio risks by withdrawing the extension of credit or loans to a particular area, but this leaves the individuals essentially with a stranded asset which they cannot sell in future if it's particularly unbankable. This isn't an issue just in the residential space. And anyone who actually hails from my hometown of Brizzy would be fully aware of the Toombul Shopping Centre, which sits in disrepair since the floods of 2022. And there's much conjecture around what exactly can be done about that particular asset, which has now been written down significantly. The last aspect that I think has been touched on quite broadly within the conference itself is around reporting and disclosures, which are vital from a transparency and accountability aspect. Lenders face mandatory regulatory requirements and also external pressures from investors to communicate their climate risks. But I think it's important to recognise and acknowledge here that lenders may not necessarily be withholding this information, and there are restrictions within the regulation itself to avoid this happening. Rather, it may simply be a lack of understanding or knowledge around these particular climate risks in themselves. Next slide, please, Mudit. If we focus a little bit more on the positives overall, sorry, Mudit, I think we're stuck on I can't tell if it's my view or your view, but we might be stuck on a potential solution slide there. In the essence of time, I'm going to continue rambling on. Hopefully everyone is happy with speaking to me. Next slide after this, please.
There we go. Yep.
Next one. If we look at a bit of a positive aspect really for a moment, there are promising developments, particularly in the way banks are tapping into thematic debt markets, such as green bonds, to effectively manage transition risks and support the transition to a decarbonised economy. I use the word thematic debt to encapsulate or encompass various different instruments, which you may have heard of, including sustainable bonds, social bonds, transition bonds, and even blue bonds. So each of these particular bonds serves a specific purpose, but overall, collectively, their aim is to mobilise capital for projects that align to sustainable goals and foster the transition overall. Green bonds in particular in Australia are starting to play a significant role and serve as a valuable tool for banks to channel their capital towards green projects. Without these instruments, fewer green loans would be available within the market themselves so that individual businesses could actually manage their own transition risks, align their operations with evolving regulation, and take part in the emerging green economy, especially those who aren't large enough to issue this sort of debt themselves. The increasing use of these instruments is also important for banks on several other fronts, but primarily through reputational uplift. They can market this and use it as positive outputs through disclosures, and also position themselves as leaders in the sustainable finance market. That said, I say this tongue in cheek because even yesterday there was a release by environmental group Market Forces that highlights that since the Paris Agreement, the big four banks in Australia have lent over $50 billion to finance coal, oil and gas companies, something I might add we all continue to benefit from in our societies overall. Next slide, please. So touched upon briefly in the slide before is the growth of the green loan markets which is actually driven by several different factors. I think the most significant of which is the fact that green loans can be designed and packaged in a way that the use of proceeds can align to general climate taxonomies, which are used to certify bonds as green overall, creating a seamless connection between the various instruments themselves. The other factors are really around a focus for businesses to future-proof their operations towards cultural shifts, looking at sustainability. Secondly, the growing ESG agenda and strong institutional demand for this sort of debt. And lastly, net zero transition plans and the shrinking carbon footprint of Australia and associated activities around that, such as investment in renewable energy sources. It's also encouraging to see that Australia, as a sovereign nation, is taking strides in sustainable finance with the plans to launch a benchmark sovereign bond by mid-2024. The sovereign issuance of these green bonds serves as a particular positive signal to the markets and will hopefully encourage more activity in this space. On the flip side of this, though, you've got to actually also recognize that the rapid expansion of these products is actually leading to a lack of uniform standards and ambiguity. And the lack of consistency in itself creates confusions for investors and others participating in this market, and also raises concerns around greenwashing, something that regulators are now starting to pick up on, including ASIC, who have pledged to crack down on this misleading practice. Next slide, please. In the essence of time, I don't want to speak too closely to this slide, but suffice to say that banks in themselves are approaching climate risks no differently to how they look at other risks that emerge within their portfolios. Various options to avoid, reduce, manage, or transfer these risks exist, but the ways in which these are being implemented leaves room for improvement and desperately needs additional expertise we believe actuaries can provide. The final option, transferring the risk, involves shifting the unwanted risk from the actual lender or bank themselves to another external party, and this aspect particularly needs the technical skill sets actuaries are known for. Risk transfer, particularly in the climate space, is a growing challenge for banks, insurers, and everyone alike who exists in the risk system that we all exist within. But it's being driven particularly by the rights for insurers to pull back or reprice their risks on an annual basis in certain markets. And in part, this is due to limited confidence or expertise in quantifying the actual risks that are underpinning the particular exposures. The current climate risk modelling metrics, such as average annual loss, probability of default, loss given default, and exposure at default that banks commonly use, are failing to capture the intricate detail that you really need to comprehensively understand these risks and the situation at hand. Without this understanding, banks and their customers are going to remain heavily exposed to potential losses in future. Next slide, please. I believe at the heart of the issue is really where I have seen the value of an actuarial voice in and amongst other professionals in a collaborative team. As a broad brush generalization, I think it's fair to say that the vulnerability of collateral assets to climate hazards in particular is not well understood. Standardization and a common modelling approach are progressing far too slowly. Depending on the approach taken, whether it is an engineering approach, a credit risk modelling approach, or other computational methods, the outcomes of the actual modelling in itself can range from a benign, there's no problem here, to this creates a significant risk for a financial institution and potentially the financial system overall. Hence, the choice of approach that you are using right now is actually determining the outcome of the modelling, and from that modelling, decisions are being made. If you look at this from the perspective of risk transfer markets, creating hedging instruments such as parametric insurance or catastrophe bonds and other forms of pseudo reinsurance really is possible and promising innovations, but without having a clear understanding of the risks, it's difficult to price them efficiently and it's affecting affordability. I think it's important to recognise that the complexity around this issue and where the risks are actually shifting within the overall risk system. And I say this between the financial system, the individuals that make up an economy, but also the government internested within it. There are certain parties within this chain that I believe fail to understand the full brunt of these risks and may be bearing more risks than they realise. The affordability of insurance is actually being referred to as a crisis, and many individuals are feeling the burden of rising insurance costs, particularly when it comes to property, but also this is being compounded by inflationary pressures that are straining household budgets and overall cost of living. Human nature dictates that we address today's problems as opposed to problems that may emerge in future. Thus, it's not surprising to see that people are either underinsuring or no longer insuring themselves in particular instances, and this in itself starts to shift the risks around the system with unintended consequences. I think actuarial input into this area is crucial, and we have the expertise and the analytical tools and the know-how to understand complex risks of this nature, and we need to be more active in this space. Next slide, please. I say all this and I try not to act like or sound like too much of a doomsayer. The reality is that lenders and banks may well be protected from certain physical risks. However, particularly if you've got a large diversified portfolio, but the uncertainty around the measurements and the modeling of this makes it exceptionally difficult for this to be said with any degree of confidence. I have also, in this presentation, conveniently separated transition and physical risks, but there's an interdependent connectivity between these two that compound risks overall. It's incredibly complex when you actually get down into the weeds of this sort of issue, and the unique perspective and skill sets of actuaries in themselves are vitally important to help with making decisions in future around lending, urban planning, and also infrastructure development as we go forward. I finished my presentation on this slide to highlight an instance where actuaries have actually been incredibly useful in the process of developing particular risk transfer solutions through the World Bank. In this instance, it's looking at trying to create a catastrophe swap and catastrophe bond in lieu of the fact that reinsurance was difficult to attain at the capacity that we needed. The reasoning that you would have an actuary involved in this is really it's quite clear once you actually get involved in it. It involves an incredibly complex system that is highly uncertain, involves risks, and has a long-term perspective. The case study here is at a sovereign level risk transfer, but I think realistically you can look at these kinds of solutions in any different form, way, shape, depending on whether it is a bank, an insurer, or otherwise. I'll wrap up there to have Mudit actually speak a little bit more specifically around the areas that actuaries can contribute. But I think that it's really important that if there is anyone in the crowd there that wants to connect with me to learn more about this, please feel free to do so. Over to you, Mudit.
Right. So just in the interest of time, I'll close this section and we can cover more in the Q&A later. So yesterday I was in a session by Dr. John Okuluru, who's doing some work with farmers in Africa, where to help them adapt to impacts of climate, they're building chatbots where the farmers can interact with the financial institutions with advice on how they can mitigate their risk. Now, there's a lot of talk about adaptation and the long-term solutions to uninsurable properties, but are there mechanisms like the solutions that Dan shared, or like what work that is being done in Africa? Can financial institutions help communities become more resilient? Before I talk about what is the role of actuaries, I also want to acknowledge that a lot of these solutions require governments, businesses, business leaders, and professionals to all come together. I do see the machinery of all these jigsaw parts of professionals starting to move in the right direction. On Monday, we saw Professor Tim Flannery talk about tipping points. And for us to have some meaningful action to avoid those tipping points, we need to have some meaningful action. And there is a lot of risk of greenwashing. To be frank, I see a lot of people make a lot of money from the work on climate, which is great. It creates jobs, it creates a transition to decarbonisation. But there's an important role for professionals like actuaries to balance those competing interests and have a long-term view and steer our clients and industries in the right direction. So I'll close with that in interest of time. And if you have any questions for Dan before he's got to go, please send them through as well.
Thank you very much. Thank you. Thanks. So we do have 5 or 10 minutes for Q&A. I don't believe there is a question online. Who do you think should lead the development of a consistent approach to quantifying climate risk?
Good question. I think it depends on the context and the purpose of the model in itself. So I don't think that, or I haven't personally seen instances where you have an actuary being at the forefront of this. They are often brought in as the technical expert and always working in and amongst the team, because again, there are so many considerations that take place whenever you are trying to do this that I don't think you can silo off particular professions and expect them to be able to comprehend every single aspect that needs to be integrated into the way you approach this. So a lot of the time you are seeing it actually being dictated by model developers in themselves, and they have a lot of power in terms of, because these are sophisticated, because they are expensive, because they take a lot of computing power in which to actually calculate these sorts of things, they have a certain sense of undue power on the actual outcome. This is what the model does, so this is what the model says, this is what the outcome is. I don't think that that's necessarily the right approach to do it. I think you need to have more input at the beginning from various different stakeholders, actuaries being one, but also the other key stakeholders, depending on the context, right? If we're talking about a bank, then the banks need to be involved, but also the people, there needs to be representations for the people who are actually being lent money to. In that instance, when you're looking at the public sector, rather, governments are often critical, but may not lack the expertise and the knowledge in which how to do this. So they need to be supported by various different groups, actuaries included, to actually help drive this forward. So not a direct answer. I think that it really does depend on the situation at hand.
And just to add, something I was fascinated by in the last couple of days, there was a lot of discussion around response to COVID and how do you balance different measures of restrictions of freedoms versus protecting health measures. And a lot of the things in that debate came around to being open to seeking wide variety of input. And obviously actuaries are great at, because of our code of conduct, we have a role to protect the public interest. So we do also have a role to provide an independent voice and helping getting input from others.
Yeah, thank you. The next question is might be slightly controversial, but interesting. Which bank do you think is doing the most to respond to climate threats?
I wouldn't be at liberty to say. I'm not in a position of knowledge of all banks. I don't think that this is a finger-pointing exercise at the banks in that they are lacking to do it. I think it is more a fundamental issue around what they can do and what they are positioned to do at this point in time. And it's not just Australia. Every country is faced with this issue, right? And less around probably promoting those who are streets ahead. I don't know that there are actually too many of those, to be frank with you, but more around, there needs to be a bit more collective and frankly, I think something around a public good that can be created to support banks and other smaller lenders. Because keep in mind as well, right, everyone will always think about the big four and because they have such a presence, particularly in residential markets, but the smaller lenders, and you see, a bit tangential, but in the US, the fact that you can have a smaller lender such as SBB have such a critical moment such that it can therefore compromise the integrity of the entire banking system. I don't think it's a stretch to say that there's some similarities between that and what you could see here with smaller lenders. So in saying that, it shouldn't just be the big banks who have the big budgets who can actually do this kind of work. It needs to be accessible and affordable for everyone who actually is involved in this.
Yeah, and just not that, I love a controversial question, but because of the way our economies operate today. I have, in my career, I have never seen a business plan that had zero growth or a negative growth. So because of how fundamentally we operate, there's a role for professionals, the banks, the institutions, but there's also a role for leadership, governments, to change the rules of the game. So it's hard to look. I mean, I think the institutions are playing the games within the rules within the cards that they're dealt. So yes, we can say some industries are better because insurers, commercially, climate has a direct impact to them, so they are ahead of the curve. But it's hard to call out any institutions because the rules of the game, they're just playing within those rules of the game.
Yeah. There's a lot of interesting questions coming in there. I'll keep some of those actually for the roundtable later on, but one maybe that one or two we can still cover now, once we'll still have Daniel with us. So first is, what work is done to stop greenwashing financial instruments?
What work is being done?
It's a complicated area, but there's a lot of development around taxonomies and the like to give a standard that needs to be adhered to provide certification, to therefore give credibility to an instrument and these kinds of things. Greenwashing is probably going to, in my opinion, is going to exist whether we like it or not. Even if you put controls in place, you will see some people or certain entities try to circumnavigate them regardless of what you do. I think that I think in the green bond space, it's what needs to be recognised is that if you have particular certifications by accredited institutions who have done the due diligence around what the green bond represents and what's it investing in, it's the closest thing that you're going to get to certainty around it. But this is, again, it's widespread also beyond climate things, and it's festering also in carbon credit markets and biodiversity, these sorts of things as well, right? It needs more work. I don't have an answer for it. I wish I did, but it's just something that frankly needs stronger regulation, absolutely, but I don't think that's the entirety of the answer.
And maybe another one. Can you talk about the risk of stranded assets in the fossil fuel sector and how banks are thinking about this?
Yeah. I think that it's fair to say that it's definitely on the agenda, and it's becoming more pronounced each year that there's greater pressure being exerted to stepping away from fossil fuels. But I think there needs to be a broader consideration here as well, right? In terms of you can't simply wean yourself off these energy sources instantly and expect there to be no repercussions of it. One of the things that in a time past that I learned when I was working with Climate Bonds Initiative and was ingrained in me is that this whole process of going down a decarbonisation and the overall economic transition is going to need to be inclusive, and sadly that is inclusive of fossil fuel firms. So whether we like it or not, there needs to be ways in which we incentivise them to change their practices to support this overall shift. Banks are seeing that as well. I don't think there is increasingly probably a slow and marginal shift away from lending into these particular industries, but I think there's probably more conversations also around, okay, we don't necessarily want to abandon you, we want to support you in changing. How do we do that from a financial context to best position you to achieve that? There needs to be a certain or additional probably efforts put through from the public sector, and you're seeing that as well with sort of the safeguard mechanism and everything to try and shift and encourage, incentivize this sort of action. But the solution simply isn't to just withdraw and expect that we will therefore have a lower carbon footprint. That's just not how it works.
And there's even been situations where some groups of customers who are not supported by Australian institutions, they've been able to get support from overseas with where there's appetite for supporting them. So given that we're operating in an international market, it's also, yes, it's a deterrent, but there are ways that high-risk customers can still get their financing.
Maybe one last question. Who can and should insure and bank those who are not green? Especially as we need to go through a transition and not all assets can go green immediately. And there's a follow-up question. Is there an ethical overlay for the profession?
Yeah, absolutely.
I guess the main question is who can and should insure and bank those who are not green?
Well, rightly or wrongly, one of the repercussions of increasingly mandatory disclosures and regulation is that you're seeing a lot of the lending from that space shift to the private sector, right? So private lending that doesn't need to provide reporting. That's the reality. Who should be stepping into that space? Well, I think that we need to be careful around how we're actually going to do this. And again, this comes down to the overall considerations around the decisions that are being made, and the acknowledgement that there does need to be, probably you're better off having a responsible party that can provide transparency to provide that lending than to have it operate and continue in the shadows. And so again, it's a very complex and interconnected problem that involves a lot of different stakeholders. I don't have a lot of the answers, sadly. It takes a lot of work and a lot of just discussion around the implications and trade-offs of different decisions. And there's no good outcome where everything is badly resolved with, or is resolved without a particular downside to it. I don't think that taking a hardline approach to simply have existing lenders completely switch the tap off immediately is worthwhile. I think having a plan in place to move away from that is important, but it needs to be taken into consideration around what the timing and the practicalities of that sort of decision is.
All right. Well, thank you. I think I'm going to stop the Q&A for now. So let's please join me in thanking Mudit and Daniel again for their insightful presentation.